Good to see you.
Hi there.
2 days later. Nice to
Yeah,
see you.
you too, Sam.
A different background this time.
A little brighter, a little bit less scary, right?
It looks like you have a great camera. I love it. Nice to see you. Cool. Well, look, it's great to. I appreciate you joining, kind of as the last panelist of our day. Would love to hear kind of the story. We've been going over of Backblaze and kind of how you got there, and specifically, the whole theme of the day has obviously been different patterns for capital light strategies where you don't raise a ton of kind of the traditional factory farmed series to series financing. And I think what's interesting is, a lot of the people we've spoken to, so, Wade from Zapier or, Anthony from Squarespace, this was their first startup, right? Like they just kind of like did it that way, and they were 20 and they had no access and probably no knowledge. You had Scott, who obviously from GoodRx, they knew what was going on in Silicon Valley, but you, I think, are kind of unique in that, like, you've done a bunch of companies, right? And you've had a ton of experience kind of with different approaches to starting them, et cetera. And with Backblaze, you kind of chose to like bootstrap and then raise very little capital and then go public really quickly. So it'd be super cool. I mean, if you're up for it, start out by telling a little bit the story of the company, right? And kind of what you're after. And then I'm really curious to hear how you came to that being the right strategy for capitalizing and building out the company.
Yeah, happy to. And I think, we went public really quickly. It only took 15 years.
Well, oh, fair enough.
So,
Sorry, I guess I'm
um,
wrong about that. But
no,
you,
no,
but you, but
it's
you very, very quickly in terms of dollars raised. How about
yeah,
that?
yeah. But I think that that is part of it, which is that sometimes the bootstrapping path is not the fastest path, but that doesn't mean it's not the best path, depending on the situation, right? So my co-founders and I had worked on two prior tech companies, like you said. Both of them were venture funded, kind of in the traditional fashion, and both of them
Yep.
were acquired. We did one in '99 and one in 2004. 2002. And so when we were starting Backblaze, we actually said, the path we knew best was actually going down the venture route.
Yep.
But we decided to not go down that path initially because there are pros and cons of going venture, there are pros and cons of doing bootstrapping. And one of the things that we decided was we said we wanted to just focus on the business, the customers, the product. And we said that the seed round was basically going to be the five of us quitting our jobs, committing to working with each other for 1 year, putting a little bit of money in, and not taking any funding for 1 year. And so that was going to be basically the seed round, because if we could go without salaries, and we actually worked out of one of my co-founders' one-bedroom apartments, and just ate ramen and lived very, very frugally and made it work. And so the story of Backblaze is basically we started the company in 2007. We raised less than $3 million in total outside capital up until just before we went public in 2021. And we raised about $10 million literally just before going public, but literally a few months before. And then we raised about $100 million in the IPO and took it public on the NASDAQ, which was very fun. We were lucky with COVID being a little bit lighter, and we could bring 70 people out to the NASDAQ in New York and shove the room completely full and ring the bell and the whole bit. But it was, in terms of why did we decide to go that path, which is different than the paths we were more familiar with. One of the things that we realized early on was that from the past two experiences was that especially early on, you're still possibly trying to figure out exactly the product market fit and exactly what you're trying to do. And part of pitching and getting investors on board is you pitch them an idea, but then if you shift, you may or may not have the right investors because you've bought them into a certain vision. And so,
Yep.
like in our prior company, we did an anti-spam offering, and it was originally started out as a consumer offering. And one of the investors was really excited about fighting spam for consumers. And then over time, we realized that really the opportunity we wanted to pursue was helping companies fight spam for all of their employees. And the investor we had on board was like, I'm not an enterprise guy. Like, it's not my thing. And so we ended up having a mismatch. So part of it was just realizing that there's a shifting sometimes that happens, and it's harder to get that alignment early on.
Yep.
Part of it is that as a management team, raising funding and managing a board of investors and everything is a real time commitment.
Yeah.
And one of the things that is the most valuable that as a founding team we have is time.
Yep.
And so we felt like if we took all of that time that we would normally spend writing pitch decks, pitching investors, managing conversations, all of that stuff, and focus that on building the company,
Yep.
we get a lot of value out of that.
Yep.
And then the other was just culture wise. So if you raise money early on, then then any employees that you have are looking at the leaders of the company and saying what they care most about is the pitching to the investors. And if that's the mental mindset,
Yep.
it's hard to establish a culture where they care mostly about satisfying the customers.
Yep.
You get employees who think mostly about satisfying the investors.
Yep.
And our early products were $5 a month. And the difference between making a customer who's paying you $5 happy versus making an investor who might write you a $10 million check happy, and convincing the employees like, no, that customer really, really important, is hard to do when the leadership team is all focused on pitching investors.
Fair enough. Fair enough. And so, I mean, I guess the other thing is you guys basically ran when you thought about from the early days, like how are you going to operate the company, even from like a profitability standpoint? Like obviously you didn't raise very much money, which means you basically stayed break even to probably slightly positive for many, many years as a private company. How much like was that like a true north thing for you where you started from saying like we want to always operate profitably, or like how did that end up being kind of the strategy you took on some of this stuff?
Yeah, so I mean, one of the things that was very strongly a thing was sustainability. And so, you've probably heard the adage lots of times that like, companies don't go out of business because they of revenue issues. They go out of business because they run out of cash,
Yeah.
right? And so one of the things that we believed was that as long as we were able to keep putting one foot in front of the other, we could navigate through lots of other challenges. Um,
Yep.
if we hit a wall and went out of business, things were done.
Yeah.
And so the question wasn't necessarily, profitability, it was sustainability. And so one example of that is when we did raise funds, we raised $2.5 million into the company 5 years in. We were not profitable. We were spending some of that money. But we also looked at it and said, we wanted to absolutely have a trajectory that when we ran out of that funding, we
Hmm.
were not forced to raise another round, that we could choose to raise another round or we could choose to be profitable.
Yep.
But we didn't want to be forced into that. And so it was always about the sustainability concept.
Yep, it makes sense. It makes sense. So talk about like kind of like you talk about a lot of like a culture. We talked about this before. Is like, again, like putting a stake in the ground around sustainability. The way you're raising, like I assume, and you guys are in your blocks from me in San Mateo. Like you're in the heart of Silicon Valley. Like talk about like the talent and the people that kind of get attracted to that mission, versus kind of some of the other options they have, like literally around the corner.
Yeah, I mean, there is different kinds of people, and one of the things that we had was, we had very, very low turnover, for many, many years, and I think that was because we found people who wanted to be part of this kind of thing. And I will say that I had a friend who at one point had worked for, I won't name the company, but one of the large tech firms, and in a function that we were recruiting for. And I said, we're having a hard time finding and filling this particular niche. And you've worked in this. You probably have friends who you could bring to us for this. Like, send me some referrals. And he's like, I would love to, but you don't want them. And I was like, that's a weird statement. And he said, my friends have gone from this tech company to this tech company to this tech company. They've been at each place for 13 months, where they basically show up, they vest there 1 year, and then they look for the next, unicorn train to hop onto, and they're mercenary.
Yeah.
And what you want is missionaries. And
Yep.
so I think that, that's obviously his perspective and a generalization, but I think that there are people who feel like they want to be kind of more kind of owners of creating something.
Yep.
And that feeling is important for them, and that's something that we can attract. And I think it is like you said, the Bay Area is expensive, and it's expensive to hire people, and it's not the kind of thing. I wish I could say that as a result of hiring missionaries, we're able to hire people for 10% of the cost. It's not the case. I mean, we're still paying basically market rate for people. I think we're just getting people who think a little bit differently about what they're looking for.
Sure. But I guess going back, like, I mean, just to think about it as a private company, obviously as a public company, it shifts because there's a value on your equity that, is somewhat liquid, et cetera. But like as a private company, like you go through so many years without raising capital. You're looking for these missionaries. You are competing against other Bay Area talent because you're literally sitting right here. Like, how do people even think about valuing their equity, right? And like, does that change? Again, like, were there missionaries who are just like, I love this, I just can't get a handle on like what you're actually paying me, or like how did that end up working out?
Yeah, I mean, so we did have this challenge where we were paying people kind of market rate salaries, and then we would hand people stock options, and people would sometimes say, I can't accept your offer because I have this offer from one of these companies down the street that's paying me similar salary, but they're giving me equity that's worth something, and you're not giving me that. And we're like, what do you mean we're not giving you that? We're giving you stock options in the company that and you're getting a material amount of the company as part of this. And they were like, I don't understand it. Like I see these RSUs and I can see what that's worth, and I don't see what your stock options are worth. And so I'm going to value them at zero. And we're like,
Yeah.
but that's not fair. Right.
Yeah.
And so, I will say that that was a challenge at various points in times. One of the things that we tried to do was paint a picture of saying, this is what percent of the company you are getting.
Yeah.
Right. Because some of it is, people don't even start with that. They just go, I get 10,000 of these magical beans from you and 50,000 of these magical beans from somebody else. And so I get 5 times more value. And it's like, that's not how the math works. Right. And so, but explaining you get this percentage of the company, if the company is worth X or Y or Z, like, this would be what your part is worth. And just, people could paint their own, like, well, I think it might be worth this, but at least giving them a framework to think about it in was quite helpful.
Yeah, and I think it's an interesting question. Also, I mean, I think I've heard a lot of people who again don't have traditional valuation benchmarks from outside sources, whatever those are worth. Forget reality. Just think about like perception. Who just say, look, it's not even worth giving people equity, right? Like, they don't know how to value it. You don't know how to value it, right? Like, there's most people in the world don't care about equity anyway, right? They're doing the bean math, as you said, they're trying to base it back to cash. So just operate your business in a way that you can afford to pay them fully loaded in cash, right? And move on. But yeah, I think it is an interesting thing. Did you ever have conversations about like, how you even think about, equity as a tool you use for compensation in kind of these types of situations? Or was it always, yes, we're giving you a percentage of the company, things like that?
So we did. I mean, I think part of the reason that we like equity is that cash is generally a this moment thing.
Sure.
Um, and
Yeah,
equity.
it's hard to be missionary if you're only paid in cash.
Exactly.
Yeah,
And we want people to feel like they are part of creating this thing, and therefore they will get to participate in whatever the financial implications are of building this thing.
fair enough. Fair enough. So let's talk about competitors. I mean, you guys are obviously, as a few people are in this that we've talked to today, in like a super competitive space, right? Like, and again, I'd be curious to hear a little bit how, again, given the fact that like obviously competing against behemoths, right? Like some really huge companies, and then like a lot of other companies in the space, like how you think about the discipline, right, around operating, call it at break even as a private company or thereabouts, and kind of the sustainability message when again you're in like a place where people are, I assume, and you can tell me I'm wrong about this, doing like pretty one-to-one bake-offs, right, on against different opportunities they have to buy different services.
Yeah, so so we offer cloud storage generally for businesses and
Yep.
enterprises and developers, right? And so we compete with like Amazon's S3 service and or Google's cloud storage service. And so I think one of the things for us is if people are comparing and contrasting, I mean, we're one-fifth the price point
Yeah.
and we have zero egress fees, so to get your data out. And so from a pure comparison perspective, people will go and look at that and go, wow, like that's a dramatically better value.
Yeah.
And then the question at some level is that we get a lot is how in the world can you be one-fifth the price of Amazon S3? Like
Yeah.
Amazon knows how to run their business. They're not generally viewed as a price gouger. Like how in the world can you be one-fifth the price of Amazon? And part of it is when we started the company, and you and I talked about this just a tiny bit on Monday, but when we started the company, our plan was actually to leverage Amazon's web services to help build our offering, right? That was going to be the underlying piece of our first product. And we looked at it and we did the math and we said, we're going to lose money on every single customer if we do that. And, again, in the traditional kind of Silicon Valley way of, sure, you make it up in volume later and figure it out. And one of the things that really enabled us to build this company is that because we bootstrapped, we
Yep.
couldn't make that choice. We
Yep.
had to build it ourselves. And
Yep.
we literally started from scratch with taking hard drives and saying, how do we plug this hard drive into the internet? And we attached a whole bunch of hard drives using, trying to daisy chain USB hubs and and we actually built plywood servers, like little plywood boxes, and deployed them in the data center in San Francisco. And we kind of closed our eyes to the sign that said no flammable objects in the data center. But we were testing, to see whether this would work. And we ended up building our own storage cloud that was very, very, very cost efficient because we had no choice. We
Yep.
didn't have a big bank account. We had to optimize every piece of it. And so, doing that with that mentality and
Yes.
having every single employee for years and years and years have that mentality, like you can't just throw money at the problem. You got to
Yep.
actually figure out how to make it work. Over years and years and years, an infinite number of small decisions helps establish that competitive framework and also
Yes.
the culture to do that, right?
Yes.
So, I mean, there were lots of things that we did. I mean, we early on we designed our own storage servers, and we used gamer power supplies in those servers. And part of the reason we used gamer power supplies was that the power supplies you use in commercial servers they have a premium on them because they're shaped in a certain way, and that shape is specifically designed for commercial servers, which means they know they can charge a premium on them. Well, gamer power supplies are designed for a consumer market. They do the same thing, but because they're targeted gamers, they don't have that premium markup. And since we could design our own server shape, we were able to choose it. So it's just lots and lots and lots of little decisions where we get to optimize against that. So at some level, one of the questions we get asked is, but won't Amazon just lower their prices to compete with you, right? And the thing is, like, first of all, like, if Amazon lowered the prices to match ours, they would lose billions and billions in revenue every year. And maybe at some point we will be generating billions in revenue, and they would say, you know what, it's
It's
worth
worth
it
it.
with
Yeah.
Backblaze. But at the moment, they haven't even decided to do that to compete with Google or with Microsoft.
Yep.
So I think we have some space to play where we can build our optimized platform. The other thing I would just say is a lot of times I think people go down this path of I'm competing with Amazon, Google, whatever, so I have to do all the things that they're doing and compete head on, and that generally doesn't work. It's a war of attrition, right? But what we get to do as a in our world is say we don't need to add a 5 billion in revenue every year.
Yep.
And so we can focus on more concrete things. So for us, we focus on storage. We don't try to do 200 different things. And we focus on mid-market companies, like companies under generally 1,000 employees. They are focused more and more on the federal government and the Fortune 500, and they need those kind of deals to move the needle for them. But that means tons of customization and tons of different things. And by focusing, we get to kind of do less and
Yep.
compete better.
It makes total sense. And I mean, I think it's another version of what we've heard from several other people today, right? Which is kind of like, I mean, it's kind of silly to say because it's kind of trite, but it's like, necessity is the mother of invention, right? Well, not if you don't have infinite capital from VC, if it's not easy, then it forces you to get strong, right? And people have talked about that a lot in terms of the people they hire and how they comp them and not letting, cut costs get out of control because it's literally, again, if the founders on the business, it's your money, right? I think what you're talking about is the other thing, which I love, which is both, I guess, two things. One is how you do it, right, and getting really scrappy and aggressive, very Walmart style, right? I wrote my senior thesis on Walmart. Love their approach. But then I think the other thing is like being really tight about how you define your product, right? You can't do everything, right? And so you have to get really aggressive about what you do and don't do. And I think both of those make a ton of sense, right? And I think it's also interesting just to kind of replay what you're saying, to like not be afraid of large competitors, right? I think several people today have said things to the effect of like, people die of indigestion, not competition, right? But being like, well, I'm willing to go after the biggest companies in the world because I understand their cost structures and I understand what they care about, and like what's too small for them to care about, but is really material. I think is a really smart take in terms of understanding what it looks like to do these things in a capital efficient way. So I guess, yeah, go ahead.
I was just gonna say, when we started the company, we had, we talked to a variety of, people who were kind of experts in the field, and many of them said, like, you guys are crazy for trying to do this. Like, like Amazon knows how to do storage, EMC knows how to do storage. I mean, all these companies know how to do storage. Why would you even bother? And the thing was, part of it was, we're like, but no one is selling us this thing, and we need this thing, right? Like, and maybe like we needed in particular, we needed a really, really inexpensive box for drives, because we would do everything else in software, and no one was going to sell us that. And we're like, so we're going to build that. And people are like, well, that's crazy. And we're like, but no one's offering what we need. And if we need it, somebody else might need it too. And
Yep.
it turned out to be surprising how many people needed that.
Yep.
But again, it wasn't, it's like these things where, like, I remember Apple was talking about, Apple TV was just a hobby for a long time. It was only $1 billion in revenue. And it wasn't like, it was like, should we even bother doing it or not? And it's like, for most startup companies, plus or minus $1 billion in revenue is kind of material.
Yep. Like, makes sense. Makes a lot of sense. So I guess the other question I wanted to ask you is, like, again, like, how, like, I understand the mentality, I understand the scrappiness, I understand the seed part, I understand kind of how you guys approach this, but I have to imagine that at several points in the company's journey over the last many years as a private company, you did get approached by venture capitalists who said, hey, we'd love to put a check in, like, or hey, like, wouldn't you go faster with some money for us now? We get that you did your super aggressive build your own plywood boxes thing, but like now, like, wouldn't you like a little bit more money? Like, was that ever on the table as a discussion with the co-founders in the group? Or like, how did those conversations go when it came up to kind of let's put it this way, like the thematically we get it, but let's not be overly dogmatic, if that makes sense.
Yeah, I mean, so what we had said was, for 1 year, when we started the company, for 1 year, we weren't going to have any of those conversations.
Yep.
But what we also said was, after that 1 year, we would have that conversation once every half year. And so we kind of said, like, well, we're not going to say that like funding is illegal, right? It's just a we didn't think it made sense to even talk about it for a year, because you can spin on it a lot, right?
Yep.
And so once every half year, we would say, like, it's worth a conversation. And the thing about it is, I think one of the things that a lot of times I think people miss is that there's this perception, especially in Silicon Valley, that just because someone gives you money, therefore you will grow faster. And A does not always equal B, right?
Yeah.
A lot of companies grow fast without funding. A lot of companies do not grow fast with funding. And I would say, I would bet, I don't have quite the data on this, but I would bet that for the majority of companies, their trajectory of growth does not change drastically when they get funding. And so I think what we looked at for a number of years was that the business that we were in, which was on the earlier side of our company, was offering computer backup, like actual end-to-end computer backup service to customers. And that business, we didn't feel like taking more cash was going to drastically accelerate. And we saw some competitors burning cash hand over fist, and frankly, not competing much more successfully with us than we were doing bootstrapped. On the other hand, when we launched Backblaze B2, which was our S3 competitor, API-based storage, and the whole bit, and we're like, the product market fit seemed very strong. We felt like we had all these opportunities. There seemed like there was a lot there. At some point, we got to the place of saying, you know what? this would benefit from more funding behind it. Like we are
Yep.
making too many trade-offs where we say no to things that feel like good opportunities.
Yep.
And that was in part what set us down a trajectory to take the company public.
Fair enough. Fair enough. Interesting. Interesting. Well, I guess the last question I'll ask you is like one of the things that people, have kind of mentioned throughout the day, which I thought was interesting, and I'm curious how you guys thought about it. Was like, look, the other nice part about having a business that's very tightly held, there isn't a lot of round-based financing and et cetera, is there's a lot of versions of a business that are super successful outcomes for the team that wouldn't be for a VC, right? And so the nice part about our business X is, oh, we get to $10 million in top line with $2 million in profit. That's a great business to own. We get to 50 with whatever. Like you guys have obviously gone public and like gone for like, building, once you're public, I feel like that creates an expectation of what you're trying to achieve, right? But I am curious, like along the private path, like, did you guys think about how the category you were in and the setup you were like, was generating options for you and the team in terms of being easy acquisitions for someone, et cetera, if you chose to not keep growing it? Or was that never part of the conversation?
So it absolutely was. So when we first started the company, we said, like, hey, we all quit our jobs. We've all committed to work on this for a year. We want to solve this problem, around data backup and data loss and storage and everything. But like, what do we want this company to look like?
Yeah.
And we on the whiteboard, we actually said, one possible option is that we're just going to run this as the 5 of us as a small private company, and we're just going to try to make a really good product that customers love and not hire anybody else, and we're just going to do that. One possibility is we're going to grow this as a private company, keep it as a private company forever, and just try to build a big private company. We said we may, like the last 2 companies that we did, we may sell the company, sell it in an acquisition. The first one that we did was sold after a year, the second one after 4 years, and we also wrote down take public as as a possible outcome, right? And I will say that when it was the 5 of us sitting in a 1-bedroom apartment, like with $0, that last item of take the company public was a little bit like trying on your parents pants or something, right? It was like sure, that seems like a fun idea, but like it wasn't very serious at the time. But all of those were possibilities. At some point, we took, when we took that $2.5 million from of investor funding 5 years in, we knew we were making a specific choice at that point, which was this was not going to be run as a private company forever. And we knew that
And just to push you, even taking just $2.5 million, you felt like that was a decision point? Because I feel like at that level, you can kind of say, like maybe we'll, it's someday maybe we can figure out a way to buy these people out or something if we need to. Like, but that was the point for you.
we said that there was a small possibility that we could do a leverage buyout or something of the team, but at some level we were kind of like, if the company is being really successful, they're going to want the much bigger return. It's going to be harder to buy them out, and if the company's not successful, we're not going to have the cash to buy them out. So that was kind of the mental thinking on it. And so we said this is most likely the point where we're setting ourselves down some trajectory of either selling the company or taking it public. And we had said we would prefer to take the company public as the outcome, because the last 2 companies they were acquired, and basically that means they vaporized, right? Like all the blood, sweat, and tears and passion that everybody put in, it's like, yes, there were some financial outcomes and stuff, but like fundamentally, like the companies dissolved. And we felt like we'd been building this thing, we had passionate people and customers and everything else, and we wanted that to live on, and taking the company public was a way to see that happen.
I get it. Cool. Adding Caroline, any last questions for Gleb? This has been a great conversation. I appreciate your time.
Yeah, one question we got was around how your approach to product development, specifically designed for your end user, was related to your smaller use of venture capital.
Yeah, it's actually a really good question. I think that one of the things that we really tried to focus on early on was self-serve, and really making it easy for customers to sign up, as part of that flow. And in part that was because we needed to. We couldn't hire 20 really expensive salespeople to go out and spend a year signing enterprise contracts before getting revenue. So we were very focused on how do we provide value today, and start collecting revenue today. Like one of the things that we did actually in that was we started charging during beta for the product. And that was controversial. People said, well, you can't charge for a beta product. And we're like, why not? Like
Yeah.
part of what we're testing is actually to see whether we're providing enough value that people will pay for the thing. That is part of the beta. And so we started collecting revenue like really, really early in.
Yeah, I will say that was, my wife, has started her company without outside financing and has run it profitably. And that was always, I always thought funny, but right, which is, the first customers paid more, not less. Yeah, interesting stuff. Cool. Well, listen, thank you so much for joining today, Gleb. I think it's a great last panel. We've obviously done a bunch of great people, and it's been really cool to see, again, like there's a lot of the stories we all know of the trillion-dollar companies, and most of those have venture financing or on a different trajectory, but like it's just really cool to see, I think looking across the spectrum from Zapier to Squarespace to you guys to GoodRx, to kind of what's going on with Instant Domain and Bo kind of telling the earlier story, that like there's just so many different patterns for building successful companies. And look, some are going to require boatloads of capital, right? And like round-based finance, there's no question about that. But I think that, when you kind of go back to the basics of like, we want to build a great company, we want to create a lot of value for ourselves and our teams, right? And do something we're passionate about. What you really see is like a lot of people taking different cuts at this story of like, who am I? What do I want to build, right? And then what's the right capital structure that matches that? And it's been super cool, I think, to see, and hopefully helpful for everyone to get some taste of this. So I appreciate you and everyone joining.
Thanks a lot. Thanks for having me.
Awesome.